Hello listeners, this is Abhishek Lahoti, Assistant Vice President at ICRA Limited, and through this podcast I will be sharing ICRA's view on cement sector. ICRA expects a volumetric growth of 7 to 8% year on year for cement output in FY2024, supported by demand from the housing and infrastructure sectors, while cement prices are expected to largely sustain at previous year levels. Backed by healthy demand prospects, the capacity addition in cement industry is estimated at 63 to 69 million MT during FY24-25, of which around 33 to 36 million MT will be added in FY24 and around 30 to 33 million in FY2025. The cement capacity is expected to rise by 6% in FY24, the highest addition in the last 5 years. ICRA's outlook on the cement sector is stable. With the softening of cost side pressures, predominantly power and fuel costs, the OPBIDTA per metric ton is expected to improve by 14 to 18% year on year to Rs 900 to 950 per metric ton. This should improve the EBITDA margin for the cement sector by 230 to 270 basis points to 16.3 to 16.7% in FY24. However, this will remain below the operating margins reported during FY17 to FY22. Power and fuel costs, which were at peak in H1 FY23, eased in H2 FY23 and are expected to further moderate in FY24, improving the operating margins. Steady demand from the housing and infrastructure sector, along with a pickup in industrial capex, is expected to support volume offtake. Nevertheless, the development of El Nino conditions could adversely impact the monsoons in 2023, impacting rural housing, which could pose some downside risk. The operating income for ICRA's sample set, which includes 12 major cement companies, witnessed a strong growth of 18% year on year in FY23, driven by volumetric growth of 13% and 5% increase in net sales realizations. However, the spike in input cost, majorly power and fuel, due to significant increase in coal and petcoke prices, impacted the operating margins, which contracted significantly by around 680 basis points to 14% in FY23. Consequently, there has been a moderation in return on capital employed and increase in leverage metrics. The credit profile of cement producers is expected to remain stable, driven by healthy growth in operating income, expected improvement in operating margins, and comfortable leverage metrics. Although the debt dependence is expected to remain high to fund the ongoing capex plans, the leverage metrics of the cement companies, as measured by total debt to EBITDA, are expected to remain comfortable at previous year levels of 1.4 to 1.5x in FY24. Consequently, the coverage metrics are also expected to remain healthy, with DSCR at 1.8 to 1.9x, supported by improvement in EBITDA in FY24. Thank you for listening and stay tuned for our upcoming podcast.